Welcome everyone to today's webinar. My name is Lisa Rodriquez, Director of Sales here at Newview Trust Company. And today we're making a case for alternatives. We have Richard Hillson, who is a financial services entrepreneur and expert in the field of alternative investments, who studied law at University of Nottingham. Before founding Hillson Consulting, he co-founded Third Seven Capital, a privately owned boutique investment bank specializing in alternative investments. And he was also CEO of an RIA aggregator. His focus is to work with advisors to improve their offerings, particularly related to alternative investments. And he was a keynote speaker for our Night with Newview event last December. And a fun fact about him is he does play in the Wilmington Symphony, and he has also played at Carnegie Hall. So welcome, Richard. We're happy to have you today.
Thanks, Lisa. Thanks for inviting me on today. So this is going to be a little bit of a condensed presentation. I think the last time I did something similar, it was probably an hour. So we might be moving through things fairly quickly here, but this is also quite similar to the presentation I did for you guys at Christmas. So high level, why alternative investments, basically? And we'll be going through some data and some other things. There's quite a bit to cover. So if any of the audience have any kind of further questions or want to dig in more detail, then please get in touch, and happy to help out with that. So let's start from the top. 60-40 is dead. The case for alternative investments. So obviously I'm trying to have somewhat of a shock value title here. Is 60-40, I would say 60-40 is antiquated and doesn't work anywhere near the way it's used to, or theoretically is supposed to work. But it is still, why do we need to look at alternative investments? So I'm Richard Hillson from Hillson Consulting, and a quick intro here, just to add on what Lisa so kindly said about me to start with, is the idea for Hillson Consulting came from my frustration in speaking with predominantly RIAs and their clients, where you would say alternative investments, the dreaded A word, alts, and you could see someone's whole body tense up when you said alternatives, because still people believe that alternatives has to mean Bobby Axelrod from Billions, black box hedge fund trading strategies, or crypto, or some other exotic high risk type investment. And actually alternatives is such a broad catch-all provision, which doesn't do us any favors here in the alts world. Is alternatives can be very predictable income flow, conservative real estate plays, oil and gas, and yet some people immediately go to the very far end of the spectrum in terms of assuming that alts have to be the most high octane and high risk asset class. So we believe that alternative investments are misunderstood, underrepresented, need to form a part of every portfolio. How do we do that? It's normally one advisor, one client at a time, and it is through education. How do we get people more comfortable with the asset class? How do we get them to understand the different verticals within the asset class and get away from this misconception that alternatives have to be high risk, high octane, things like crypto or hedge fund trading strategies, which again, there's a broad range of hedge fund trading strategies. So that's my mission statement, my raison d'etre. And we work with advisors and their clients to help them navigate the alt space. And we work with product sponsors in the alt space to help them connect with their target market and educate their target market as well in terms of getting their audience comfortable with alternatives in general. So what are alternative investments? I've touched on this a little bit already, but really can include anything. It's easier to say what alts are not rather than what they are. Anything other than stocks, bonds, or cash. So that really can include arts and antiques. It can include classic cars. I looked recently at an investment in whiskey casks in Ireland or Scotland. And so it's such a broad terminology. And it causes a problem because, yes, crypto is classed as an alternative investment, but that is a very different risk profile than real estate or infrastructure real estate or commodities. So, and even when you dig into an area such as private equity and venture capital, which is a vertical within the overall alt space, there's different risk profiles within that. There's different return profiles within that. So this broad terminology and grouping everything together is a real problem for the industry. If I could think of a better terminology for alts, I've tried really hard. I've not come up with anything. Answers in an email, please. But the terminology causes a massive problem with a lot of advisors and their clients who just classify things, too many different things together under that one terminology. So let's talk the other side of 60-40. So the 60-40 allocation is the textbook style definition of portfolio management that they still teach in business schools, which I disagree with. I think it's a dated model. But historically, 60-40 means 60% in stocks and 40% in bonds. So you have your capital appreciation here, which normally comes from the equity market, and you have your yield, your income stream on the 40. That will dig in more about why that is an issue in modern portfolio management. But this was the core principle for, I can't even remember how long, the last 50, 60 years or whatever. And it's almost I like my analogies, as you'll probably realize as we go on, but my analogy here is I remember when I was doing my first kind of biology and nutrition lessons when I was 7, 8 or whatever at school, and they would teach you that your diet should be, I think it was 70% carbohydrates, 20% protein, 10% fat. And nowadays it's something like 20 to 30% carbs, a lot more fat and more protein based in a healthy diet, because the original model was built on marathon runners and athletes who needed a much higher percentage of carbohydrates in their diet. So it's literally that wrong, in my opinion, and is such a dated model that the only thing I can compare it to is that old nutritional model, which has been proven to be absurd. And people in the 80s and 90s wondered why they couldn't lose weight on what was supposed to be a healthy diet. So kind of a slightly connected analogy there, but that's how I describe it. Is it's a dated model which needs improving, and alternatives have to be a part of that portfolio. But when I'm talking about 60-40, this is what I mean here, the traditional portfolio construction theoretical model. So the problem with 60-40, stocks are subject to market volatility. Bonds, the yield variability, we have issues with interest rates there, which mean that that's quite cyclical and can be volatile in nature. And cash, obviously, we've got the inflationary pressures, which is really topical at the moment in this high inflation environment. And I was saying to people back in 2021 that those who were in the 60-40 model and were bang the table disciples of the 60-40 model wouldn't look at alternatives or less correlated asset classes, is they were actually shifting to 70-30 in terms of weighting to equities, or in, God forbid, some cases 80-20. So not only was that setting themselves up for disaster when we had the inevitable market correction, but it was actually exacerbating the overheating in the market, where you had more money flow into equities, which was continually fueling the rise, which was just unsustainable. So this is the basic problem with that model. And we saw it, that people who were investing even further into equities actually just fueled that issue that we were bound to have when there was a correction. And I remember in my early economics and portfolio theory classes, is the example they'd give is in a 5-year cycle, you get 3 years where equities perform, 2 years where equities don't perform. Hopefully the bond yield was inverse to that, so you'd at least still have a return, and hope that you ended up in the net positive in a 5-year period. I don't want 2 years of sitting there watching my equity portfolio go down. I want to look for other asset classes that will give me a positive return while the equity market's not performing, and only alternative investments can do that. So that was the old model, which is, in my opinion, heinously broken nowadays. Let's talk a little bit about this here. So the 60-40 portfolio is under pressure. So let's look here is stocks down and bonds up. And then the inverse, stocks up and bonds down. So the idea is that in the old 60-40, you'd always be able to get some kind of total return somewhere, whether it was from stocks or bonds, because in certain periods of history, they had an inverse correlation. So that was important. And it meant that the 60-40 model actually would deliver over a 5-year period. Now, when I say 5-year period, the first thing anyone's going to say is, well, we've just had a 10-year plus equity run. And yes, we have. That's a bit of an anomaly if you look at the historical data. But yes, we have. And I agree that it's hard to take money away from equity markets when they're performing well, because if you miss time where you think the peak is, you're going to have investors saying, why did you put me in real estate when the equity market has performed for the last 12 months? But it's about the longer term strategy here. And people who stayed in and tried to time this have probably ended up with some egg on their face as far as their clients are concerned. Looking back to the data here, is this inverse correlation is good for the 60-40 model. Then we have stocks up, bonds up, which is even better for the old 60-40 model. And this presentation was using some 2022 data where, yes, we've had somewhat of a rally here, and therefore this changes the data slightly. But let's look at 2022 as an example, is stocks down and bonds down. So at that point, where are you going to get any kind of return other than sitting there, tapping the table, waiting for a rally in either of those asset classes? Because there's no other options in your offering at the moment to your clients. So it's been a historically bad period where the 60-40 model has dramatically underperformed because of certain circumstances. But hopefully that serves as the wake-up call for everyone, where we need asset classes that are less correlated to stocks and bonds to actually deliver a return, different return profiles for their clients. Recent performance delivered a loss of 16%. And this is a slightly dated slide from a presentation I did a few months ago. So I know that those figures will be slightly skewed now, but that was still over a 12-month period in the not too recent past, after 14% to 22% over the previous 3 years. So that's, if there's ever a period where you can actually lose that amount of money in your portfolio over any period of time, something is wrong. I don't want to be in the shoes of any financial advisor who's sitting there with clients that have to explain this because of lack of diversification into less correlated asset classes. I'll stop ranting about that now, but as you can tell, I feel pretty strongly about this.
I do have a quick question, Richard. I wanted to chime in. And I know you're not Warren Buffett, but how have you dealt with the conversations around, underperformance?
Yeah, so fortunately, most of the advisors I'd been speaking with, I'd been banging the table for a good period before, saying you have to diversify into other asset classes. Economics teaches us that everything is cyclical to some degree, and everything is interconnected to some degree. Is real estate will be impacted by the equity market one way or another. And I'm not here to talk about the mathematical correlation, 0.2% positive correlation, inverse correlation, etc. I'm not that smart. It's just the accent that makes me sound it. But so everything is correlated, but less correlated asset classes. So I've been saying to advisors for years, yes, it's hard to move away from equities when they're performing. Yes, there might be some difficult conversations with clients if they say, hang on, we came out of equities to a degree and they've really performed well over the last 6 months. Yeah, it's the long-term planning game into a really diversified portfolio, diversified away from the 60-40, diversified within alternatives, some in private credit, some in real estate, different diversification within real estate, whether that's multifamily or industrial, commodities, some private equity plays in there as well. So it's preparing for the long game, so that you can always retweak the portfolio, but having this fundamental basis of asset classes which have different return profiles. So you are not just going through this historical 3 years up, 2 years down, hope we net something in the middle kind of thing. So my solution to anyone that I'd not been in their ear for the last couple of years about anyway is it's this long-term planning where you need different types of return profiles, different types of risk profiles, and true diversification can only be accomplished using alternatives and using different types of alternatives. Long-winded answer there, Lisa, but hopefully that hit the point you wanted.
Yeah, thank you.
So let's look at, always follow the smart money is the endowments. Let's look at, and actually I think the allocations are even higher into alts over the last couple of years. But for the last 10 years plus, they've been allocating over 50% into alts. That's very significant. If the smartest guys in the room have been allocating over 50% to alternative investment, and look at that, is their equity has been 30%, 35% or so, not the 60 from the traditional model. So alternative strategies have been a huge part of their portfolios, the smartest guys in the room. Now, the pushback I always get on this is, yeah, but these guys have 20 MIT, Harvard graduates running their diligence and their portfolios. And I get it, is a lot of these allocations are private equity models, which needs teams to due diligence. It's tough. So I understand that many advisors are small teams, or even a single practitioner wearing multiple hats, wearing the hat of sales development, portfolio management, client relationship management. Do you want to throw an investment banker hat into that as well? It's tough. I get it. But there's the way the world has moved is that alternatives are a lot easier to access, and there's a lot of support out there, and we'll talk about that more. So I'm not advocating that anyone should be allocating over 50% to alts if they don't have the team behind them, but it's very telling just how high the allocation here is in the smartest guys in the room. Endowment performance. Now we can see, let's compare their performance to the 60-40 model. There's a huge gulf there, because they are allocating and building their portfolios in a different way. And I get it, is again, team of MIT and Harvard guys in the back room. We don't all have that value, but it is telling the gulf between portfolios that actually do include alternative strategies. Let's talk about the growth of the alts market here. So here's some figures in terms of how much it has grown over the last decade or so. Mark Rowan from Apollo raised in a recent comment that he could see the day where 50% of retail, not just institutional, but retail investors' portfolios, 50% plus would be in alts. That's a huge statement. 81% of investors said they expect to increase allocation to alts in the next 5 years. And then some more stats there in terms of the growth of the alts market. So we are getting there. There is a trend that another analogy coming, warning. I did say I like analogies, but I sometimes say that alts used to be the Amex Centurion card, which I think you need to spend 250 grand a year on the card to get the Centurion card. It's the black one that gets you into the US Open in the press box or whatever. And nowadays, alts are now more like the Amex Platinum card, which is, I mean, a lot of my friends have that card. So alts used to be only for the ultra high net worth family office types. And nowadays, most mass affluent investors can actually have access to alternatives. And we'll go into some of the reasons why there, but we have seen this pretty seismic shift in terms of alts growth and also alts becoming more accessible. And not just the log into your custodian platform and find a fund of funds in the alt space, but real individual institutional quality product. That's a huge shift in the industry. Few more stats on this here is to see private credit being up there is, most of the reports say private credit is one of the fastest growing areas of the alts market. It used to be predominantly real estate would be the front runner because it was the easiest one. A public REIT I've called a gateway drug in a few presentations because it's the easiest way for an advisor or for a client who don't understand alternatives and might say, private credit, private debt, that's a bit far at the moment. But most people will have a working knowledge of real estate, whether they own a second home, an Airbnb. And so it's not a big step for them to actually allocate to an institutional real estate provider. But we're seeing other asset classes. Private credit has been shooting up there. I like a lot of private credit strategies at the moment. So it's not just one area of alts that is growing. There's a lot out there. New investment landscape. So we've talked a little about this, but it's really about the ease of use. Is that and actually, let's just talk about the minimum ticket size here. And these two pretty basic pie charts will just give you an idea. Back to my Amex card analogy, is that it used to be the case that the minimum ticket size in most alternatives was at least 250K, if not $500,000 or $1 million. So even just using this model, if you've got an investor who you're not just going to allocate into one alternative sponsor, you're going to need 4 at least to have some modicum of diversification. So that your alts allocation is $1 million. If the alternative part of your portfolio is 10%, that means your portfolio needs to be 10 million. So your net worth is north of 10 million. That's certainly not the mass affluent. Most advisors might have 1 or 2 of those clients, but that's not the case. Nowadays, with minimums in the much lower range for quality institutional providers, you can build a 4-piece diversified alts portfolio with 100 grand, which means your net worth is just north of $1 million potentially. Think how many new clients that opens things up to. So it's a big deal that the lower minimums is a significant trend at the moment. I made an investment for 10 grand recently into an alt sponsor I liked, and their minimum was $2,500. So it varies, but the industry is moving that way, as well as making it easier for custody and reporting. The third-party due diligence companies help us all sleep better at night because they write a separate report where they really dig into the sponsor so that we not only can read it and understand if we're not ready to do our heavy due diligence, even legal due diligence on the principles. Third-party reports are really significant there. And the quality of products is huge. True quality institutional products are available where an individual investor can invest on the same terms as a family office putting 10 million in some of these types of products. So Lisa, a question for you, because I'm a big fan of NewView. I have my own accounts with you guys. Shameless plug there. I have my own accounts with you guys, but it's people like you guys who are making it easier. When you used to go to Schwab, Fidelity, TD, whatever, and try to get alts on the custodian a few years ago, it was a mission of a process, and there were fees there as well. You guys have done a great job in actually making alts more accessible from a custody point of view. How much have you seen this growth over the last 5 years or whatever in terms of just the volume of allocations to alternatives?
Mm-hmm. Yeah, I mean, we've definitely seen an increase in people that are seeking out alternatives. I attend tons of conferences, industry conferences, broker dealers, and there's more access. There's more fund managers present. There's an increase in the buzz around alternatives. We do aggregate data, so we do participate in data aggregation, which is helpful. And then we do integrate with some of the fintech partners that we, meet at these investment conferences. And I think all of that is helpful to get it to a more streamlined process as time progresses.
Yeah. And again, I'm a personal fan and a personal user, is you guys make it so easy to onboard alternative investments, where some advisors I've recommended to you, they've just simply not been able to custody anywhere else for certain assets. So it is a change in the industry and groups making it easier and providing services that are much easier to actually accommodate the alts world.
Thank you.
So, of course. So why are alts underallocated? And we've touched on a lot of these points, but the broad terminology, misunderstanding, or clients had a bad experience. If someone says, oh, my clients once had a bad experience in crypto, so I won't look at alts. So that means you won't look at real estate? And that doesn't make sense to me. That's like saying I once made a bad stock pick and I'm never picking a stock ever again. Doesn't make sense. Custody and reporting. Again, groups like NewView are really helping us in terms of the custody, and there are solutions there for advisors to be able to aggregate different custodians. I always advocate for having a regular custodian and then a separate alts custodian who make it easier, and the technology makes it easier to pull all this together from a reporting point of view. Liquidity misconception. This could be a lecture on its own about why illiquidity is not a bad thing. It stops emotional, irrational investing. Think about all these people that dumped all their equities when COVID began. I have to say, I thought that March dip would have lasted a lot longer, and I thought that was actually the kicker for a prolonged bear market. It wasn't. I was wrong in that, but many people made that reaction and then tried to time the market and ended up in a bad situation. If you're long-term planning, illiquidity is actually your friend, and you get the illiquidity premium because the sponsor needs to offer you more for the illiquid nature of it. So I actually wrote an article on that called "Illiquidity is Not Your Enemy," I believe. If anyone wants a copy of that, then happy to oblige. And then navigating the asset class. Someone logs on to one of these marketplaces or a third-party provider and types in opportunity zone, and 30 options come out, and suddenly your head's spinning around like the girl from The Exorcist because it's overwhelming the amount of options out there. I get it. It's difficult to navigate the marketplace, but consultants such as myself can help with that. Third-party diligence reports, the marketplaces themselves often pull me in to say, we've got an advisor who's dipping their toe in the water, or a client that's dipping their toe in the water. So the support is out there, and it's improving all of the time. Education is the number one theme in this space at the moment. So why alternative investments? And this is really for the advisors out there rather than individual clients, but competitive advantage. If you don't have sophisticated alts options, your competitors do. You will not attract high net worth sophisticated clients without them. Client demand. Clients know about this. Sophisticated clients know even more about this. They will say, my friends are all using DSTs or OZs at the golf club. Why are you not telling me about that? Competitors are using alts. Already covered that. Business development. In order to land the higher net worth sophisticated clients, you need to have this in your offering. Fee compression. I wrote another article called "In a World of Fee Compression, Avoid the Race to the Bottom." Don't compete with Betterment at 15, 20 bips for robo portfolios. Provide a better service, which includes tax planning through opportunity zones, Delaware statutory trust, sophisticated alts offerings, and keep your fee at 1% by offering a better service. And then for everyone here, less correlation to equity markets. I think we've already beat that one to death in terms of looking at that. Often real assets or real asset backed. It's not based on investor sentiment where a firm misses their earnings by a couple of cents and suddenly that whole industry is down 5% on the public markets. It's often real assets, and the valuation is based on independent third-party valuations rather than just stock market sentiment. And yield, I think alts actually are a great substitute for bonds at the moment. Is find a yield-based alternative and swap that out for some bonds. Alts don't have to come out of the risk capital in your portfolio. Depends on the profile. If this is conservative and is offering 12% at the moment, that replaces some 40 in the portfolio, in my opinion. So the return profiles are also different in alts depending on what type of alts you're looking at. So first of all, thanks everyone for listening. Thanks NewView for inviting me on today. This says Q&A, but I guess that's over to you, Lisa, in a second if there's any questions there. But here's my details, and happy to follow up with any questions or any discussions that people want to have after this.
Yeah, thank you so much. I know you're a highly sought after speaker in the alternative space. You help to bridge that gap, and I know it takes time and effort to join us. So we really appreciate your time and energy towards this presentation. And I absolutely found your analogies entertaining. So thank you for that as well. And we appreciate you again.
Thanks, and I'm glad someone laughed at them, even if not most people. So I appreciate that, and always appreciate you guys. And thanks for